resource-rich African countries are determined to capitalize on high commodity prices in order to bolster weak state balance sheets. This has led to the renewed debate on the role of government in Africa's mining sector. African governments are now exploring new channels through which strategic minerals can be optimized.
Africa is undoubtedly endowed with an abundance of mineral wealth, and mining companies are looking to extract this in a more sustainable and cost-effective manner. This has evoked political pressures on government on the continent to take a more proactive and strategic role in the mining sector. Government involvement in the sector has come about in various ways, from outright nationalization and expropriation of natural resources to control measures by corporations. According to a recent report by Ernst & Young on the business risks facing mining and metals, out of a list of the 10 most troubling risks in the mining industry, resource nationalism is what keeps mining companies awake at night.
Business generally don't like uncertainty, and therefore there is, as it were, an opportunity cost. And secondly is that there are some investments which may go somewhere else, in some other investment destinations in the world. And for us, we feel that is regrettable. However, what we know is the minerals will always be here.
Although historically state ownership in sub-Saharan Africa has lacked luster, and most mining companies in Africa have not had much operational success, countries like Namibia and Zimbabwe have taken a bold approach towards state ownership. For example, this year, the Namibian government announced its intention to grant its state mining company, Epangelo, exclusivity to the exploration of its strategic minerals, namely copper, gold, zinc, coal, and uranium. But it is worth noting that there isn't necessarily a direct correlation between poor performance and state-owned mining companies. There has been some positive examples, such as in the case of Botswana, and taking into account that most failures that occurred in the 70s and 80s were fueled by poor infrastructure investment and a period of slumping commodity prices. The tax regime governing the African mining industry has also been top of the agenda for most governments this year. Other factors such as access to water and energy against the backdrop of labour unrest are just some of the pressing issues affecting the profitability of mining companies on the continent.
Now joining me in studio to take a closer look at Africa's mining sector is Cobus Nel, his mining analyst at Stanlib. Also in the studio with us is Warren Beach, his head of mining, Rutledge Modise Inc. Last but not least, from our Cape Town bureau, we've got Peter Major, mining analyst with Cadiz Corporate Solutions. Welcome, gentlemen. Let me begin with you, Warren, and ask whether the models that we've had for extracting mineral resources out of the African soil since exploration on the continent, exploitation started, have worked.
Godfrey, not all of the models have worked all of the time. We are progressing along a chain of implementation of various models, and they're not perfect, and they certainly are far from being perfect.
Outline them for us very quickly if you can.
The various models are from a purely state-owned extracted beneficiation chain to a purely privately owned extraction and beneficiation chain. So there's various models in between, and as we've seen in the introduction, there are good examples of purely state-owned, extracted, beneficiated, sold, marketed models. But at the same time, we shouldn't forget about the privately owned processes that have led to the infrastructure development, for example, that we have in South Africa.
Okay. Cobus, let me come to you. Do we have any examples in Africa of the model that has worked the best versus the other models that he has just outlined?
Look, I guess ultimately it's, it depends, and it depends on your inputs on many of these models. Like we've seen, we've been one of the countries, I think, that had probably the cheapest electricity globally. Right. Moving to a country where it's probably one of the most expensive electricity inputs.
Indeed, I was going to say no longer.
Exactly, and so you've got very other factors. So something in a model and something that you implemented 10 years ago, 15 years ago might have worked well. But when you look at it now, its feasibility relative to the rest of the globe is probably not as viable. And that's the challenge for any country, to remain competitive with the globe, in terms of there is a fight for so-called GDP growth globally, and we've seen even producers in South Africa want to export chrome, put it on a ship, export it out to China to be actually processed there at a cheaper rate, which they claim, what they can do here. And that, you know, asks some serious questions.
Yeah, there's no one perhaps better placed than you to discuss the current model that we have, where you've got private shareholders and these companies are listed on stock exchanges, and therefore by extension, of course, they are owned by the public, but we do know that generally they do benefit a smaller section of the population. When you look at the current model, how sustainable is that, do you think? And do you see change down the road? I want Peter to think about that as well. I'm coming to you shortly.
Yeah, look, it's always got to be a model that's got a balance, because you know when you look at a company, it's like a big pie, obviously, and we know there's the various stakeholders within that, and each of them, you know, contributes at a certain percentage, you know, towards their profit in the end of the day, etc., etc. So I guess ultimately, you know, if you look about sustainability, you got to look about the, you know, almost the whole pie, and being able to say, how can we extract the best value that we possibly can out of this pie?
Yeah.
If it means, you know, there's a certain return that shareholders got to be happy with because, you know, there's some other requirements that got to be fulfilled, you know, to sort of make the whole model work, then that is the case. And I think, you know, getting that balance is always a challenge, because each of those sort of participants in that pie obviously want to maximize their share.
Do you see change down the road?
I think so. You know what we've seen of late, and a greater emphasis maybe on the communities and on, you know, your social responsible investment, I mean, is a key theme. You know, when we do look at companies and we invest money on behalf of clients, that is a key sort of consideration we take into account when we make those decisions.
Yeah. Peter, let me come to you. Do you see change down the road in terms of how we are currently exploiting mineral resources in Africa?
Oh, definitely, Godfrey. But I don't know if it's positive change or negative change.
For
because
who?
If I look at maybe 20, 30 years ago, we were doing a better job, I think, of extracting the minerals out of the ground on our deep level gold mines than we are now. Because 30 years ago, the government mining engineer worked quite closely with management to make sure they mined to the average of their grade, and they couldn't leave vast pockets of ore behind. And unfortunately, the last 10 years, I think we're seeing a bit of rape and plunder. We're seeing mines just running with whatever ore they can, and they're mining on a much more short-term basis because they don't know if they're going to be nationalized. They don't know if they're going to have a wildcat strike or be closed down. They don't know if the tax rates are going to go up or the royalties going up. So I think we're mining on a less sustainable basis than we were 30 years ago. And the change I want to see going forward, the change everybody wants to see, is sustainability. These mines must be run so that they can sustain their operations for as long as possible until every last ounce of ore is out of the ground.
So what kind of change do you see then?
To get that kind of change, you need certainty and you need consistency. You need collaboration and cooperation. That means between the government, the union, management, and workers. Everybody's got to be in agreement before you even sink a shaft, before anybody goes underground. We want this mine to last as long as possible. We want this mine to create as many jobs as possible. And we don't want to see this mine running just to make as many short-term profits in the next 3 or 4 years, and then closing when it's still got half its ore in the ground, or running on half the force that could be run here just so they can maximize profits.
Okay. Warren, let me come to you. Build for me then this model of the future, if you like, for mining. What would it look like? He is talking about trying to get all stakeholders together, so the miners, the governments, the workers, the communities in which these companies are operating. And I'm seeing a lot of people at that table that I can't see unanimity of voice there.
Godfrey, just to follow on from what Peter has indicated, I think one of the most important changes that has occurred between the previous minerals model and this one is a emphasis shift from a purely shareholder model to a stakeholder model.
Right.
And if you had to describe our the Minerals Act environment versus the Mineral and Petroleum Resource Development environment, that is the single biggest change from a conceptual point of view to a stakeholder model. In other words, where the stakeholders are not just the acknowledged shareholders, but the employees, the communities that are impacted by mining, and of course government and the regulators. So that model or that concept is already in our law in terms of the new legislation. It's a question now of implementing that to a genuine participative stakeholder model involving both government and the private sector as dominant parties or predominant parties, and then of course together with the stakeholders that make the difference to that mining community.
So you are saying in effect that you can't have the whole model where you've got a state-owned enterprise that is mining on its own working, neither can you have a private sector one also working on its own. You need a combination of both.
Godfrey, I would suggest that we need a combination of both. In other words, I think that certainly in the South African context, the purely state-owned model or the state-owned concept can work, and it should work. We do have the state-owned mining company. We do have the private model. It has a place. But going forward, we are probably looking at a combined model.
You remember when we were discussing before we came onto the show, one of the questions I asked you is, how do you make sure that on the government side, they select the right people with technical know-how as well as competency? How do we do that? Because we do know that governments, to a large degree, okay, I'm going to sound not politically correct here, but they are largely unaccountable. They don't account to anybody very well, do they?
Godfrey, 100% correct. There is an accountability issue and a perception that where there's lack of accountability, there should be no input, in other words, investment, etc. But having said that, the models that have been looked at and can be applied can certainly take into account the best of both worlds. Your first question to me is, how do you ensure that government retains the best people? And the best way of retaining people, obviously, is you pay them properly. And the second thing that we would probably need is some sort of commitment from the private sector not to poach.
Indeed. We're going to come back and cover some of those issues in the second part. But before we go, I just wanted to come to you, Cobus. I was just reading a little bit, and I found that there are 2 countries in the world where mining has actually benefited the country as a whole, plus the community as well as the workers. Apparently Sweden and Norway have done a very, very good job in trying to look after the interests of all stakeholders. Should that not be what we should be looking at?
100%, and I think, like we said, you want to avoid leakage. And when I say leakage is maybe what we've seen of late, 6 weeks of strikes. No one gains out of this. It takes them 3 years to actually make up over months of salary that they lost. Even if they got a 3% increase, there is literally no winners. You've actually, and your relative competitive position, maybe to a miner in Australia or Canada, etc., has deteriorated. And then you've got leakage of value, and ultimately I think if you can be effective in the whole structure of optimizing that value, it's possible. It's possible that everyone actually gets out more than what you would think if everyone's not working together.